Singapore's exports could become cheaper in the short term as the central bank moves to loosen monetary policy amid easing inflation. As the Singdollar appreciates at a slower pace, imported costs are expected to stay moderate, with analysts adding that further easing could be on the cards as global growth slows. Nasyrah Rohim with this report.
Inflation in Singapore halved to 2.4% last year from previous year. Now, alongside slowing global price hikes, this has given the central bank the confidence to ease monetary policy for the first time in 5 years. What this means is that the Singdollar will still continue to strengthen against a basket of currencies, just not as strong as before.
On balance, it means that your imported goods, the prices may still stay more stable, especially if in those foreign countries, they are still having some domestic price increases, some lingering inflation in those jurisdictions. And at the same time, I think it also means that the currency movements against other currencies may be more stable. So it means that your holiday prices are going to be more stable compared to, I think, a few years ago.
The risk, though, are rising uncertainties to global economic policy, especially in the White House.
We're talking about a tariff of 10% on China.
These increased trade policy frictions could then ultimately hit open economies like Singapore. Already, GDP growth this year is expected to ease.
We think that increased protectionism and more trade frictions globally in terms of tariffs may actually be a drag on the manufacturing as well as trade-related sectors. However, we do think that the Singapore economy has much to look forward to. These are a generous election budget, and the other resilience factor would also be a construction boom, in the sense that our construction sector is has a lot of infrastructure projects, as well as the expansion of private projects such as integrated resorts going on.
For this year, MAS has cut its forecast for core inflation, which excludes accommodation and private transport costs, between 1 to 2%, lower than the 1.5 to 2.5% projected last year.
Despite easing inflation, analysts expect the upcoming budget will include more transfers to tackle cost of living concerns. Apart from short-term relief, they add that some focus could be given to long-term priorities, like positioning the Singapore economy for future growth and adapting to the changing global environment.
There will be a lot more allocations as well for things that will allow the economy to be more resilient to these kinds of risks, and more reforms, more spending on labor upskilling and human capital investment. So these things I think will be very important as well, and not just the short run the type of support measures that we're going to get.
And for more analysis on what this would mean for consumers and businesses, we're joined by Swan Tek Kin. He is Head of Research at UOB. Mrs. Swan, thank you so much for joining us. First of all, how significant is this easing of monetary policy for the first time in 5 years?
Right. Good evening, Shahida. Well, in terms of significance, this policy change is a signal about the Singapore policy stance that we have been having over the past few years. If you remember, between 2021 to 2022, MAS policy has been on a tightening stance or tightening trend. That means the Singdollar appreciation now is I would say a reversal, but we already stopped that, and then we are going to kind of stepping back from the previous policy stance to slower appreciation of the Singdollar on a trade-weighted basis.
And how are you predicting the Singdollar would move then?
Well, I think the Singdollar at this point, we have to think about two things. One is the appreciation stance of the Singdollar will be slower than compared to before. It does not mean depreciation on its own, but it also depends on how the other one is the US dollar. How does the US dollar perform against Singdollar and against other currencies? So if the US dollar is strengthening, then the Singdollar will probably have to weaken along with the rest as well. So in terms of weakening, maybe in this policy stance, the weakening speed may not be as much as compared to other regional currencies.
Since a weaker currency may make certain purchases more expensive, Mr. Swan, what does this mean for consumers at the end of the day?
So if you look back over the past few years, Singdollar has actually been on an appreciation bias against many currencies on a trade-weighted basis, what we say that, as a whole. So if you just take an example, for example, Malaysia ringgit, in 2020, it was around 3 ringgit to 1 Sing dollar. And then at one point, last year, 2024, the ringgit fell to as much as 3.48. So Sing dollar strengthened against ringgit and against other currencies. So at this point, we are likely to see the appreciation is not going to be as much as what we used to see, but it does not mean a depreciation. So Sing dollar will still hold its own. So that means for consumers, your so-called purchasing power may not be as strong as before, but nonetheless, Sing dollar is still relatively strong over the past few years because of the MAS policy. And
do you see further easing on the cards?
Potentially, it all depends on one important thing is Trump trade policy. So I think if you think about tariff, if tariff were to happen and in a big way, that could have an impact on Singapore economy and manufacturing sector and export sector significantly. So in those situations, MAS will probably have to take further actions. For example, in this sort of loosening of the currency in a more frequent manner, and also for a longer time. So it all depends on foreign trade policy because of Singapore open nature of its economy.
You mentioned the Trump terrorist threats there. Besides potential trade restrictions, Mr. Swan, what are some risks to global growth that we might be missing?
Okay, so I think Trump policy is the trade policy. I think it's a big one for Singapore because of open nature. So I think for other Trump policy, I don't think there's a significant impact on Singapore. But for Trump, if there's a tariff policy, the impact on growth is more so compared to inflation in Singapore. So as a result, MAS is, I would imagine MAS is paying very close attention to what Trump may have on his policy platform in terms of trade. So that is something that we have to watch very carefully and closely.
And amid all of this, Mrs. Swan, your take on the bright spots?
Okay, the bright spot is we have seen so far Trump has not been as aggressive as we thought he would be on trade policy. So that I think would give us some breathing room. But at the same time, I think for Singapore itself is quite resilient. And some of these projects and construction projects that have been going on, I think that will give us a bit of more room for Singapore to move. And also, the upcoming budget is likely to be a bit more likely to be on a generous side. So I think that will give Singapore quite a bit of headroom for the upcoming year. And also, the last thing is the regional economy has been performing well, and that would help Singapore as well.
All right, appreciate your insights, Mrs. Swan. Thank you so much. Swan Tek Kin, the head of research at UOB.